Nvidia's stock rose over 200% in 1 year. But here's the question nobody asks. Does the business actually justify that price? Most investors buy the story. The AI story, the future story. We're not doing that today. We're looking at the numbers, all of them, good and bad. By the end of this video, you'll know exactly what Nvidia's business looks like on paper, and whether the market is pricing reality or expectation. Nvidia crossed a $3 trillion market cap in 2024. That put it briefly ahead of Apple. To put that in perspective, Nvidia's revenue in 2023 was $61 billion. Apple's was $383 billion. So the market is pricing Nvidia like it will grow into one of the most dominant businesses in history. Maybe it will, but that's not a fact. That's a forecast. And forecasts are not the same as fundamentals. The question isn't whether AI is real. It is. The question is Nvidia priced for perfection? And what happens if anything goes slightly wrong? Nvidia sells GPUs, graphics processing units, originally for gaming, now primarily for AI model training and inference. Their data center segment, the AI engine, generated $47.5 billion in fiscal year 2024. That's up from $15 billion the year before. That's a 217% increase in one segment in 1 year. Gross margins are at 74%. That means for every dollar of revenue, Nvidia keeps 74 cents before operating costs. That's exceptional. For comparison, Intel's gross margin is around 40%. But here's what matters more: pricing power. Nvidia's H100 GPU was selling for $30,000 to $40,000 per chip. Demand outstripped supply for most of 2023 and 2024. That's real pricing power. That's rare. So what does that actually mean for investors? It means Nvidia isn't just riding a trend. It's the infrastructure behind the trend. Right now, there's no serious alternative at scale. As of mid-2024, Nvidia traded at roughly 65-70x forward earnings. The S&P 500 average is around 20x. So you are paying 3 times the market multiple for Nvidia. Is that irrational? Not necessarily. High-growth companies command high multiples, but it means the market has already priced in years of flawless execution. The PEG ratio, price to earnings divided by growth rate, tells a different story. Nvidia's PEG sits around 1.2 to 1.5, depending on which growth estimate you use. Historically, below 1 is considered undervalued. Above 2 is stretched. So Nvidia sits in the middle, elevated but not extreme. Free cash flow is the cleaner metric. Nvidia generated around $27 billion in free cash flow in fiscal 2024. At its peak market cap, that's a price-to-free cash flow ratio of over 100x. That's the number that should make you pause, not in a panic, but in a thoughtful way. Momentum isn't hype, it's data. Nvidia has outperformed the Nasdaq by over 150 percentage points on a 12-month basis. Institutional ownership has increased. Analyst estimate revisions have been consistently upward. That's meaningful. When analysts keep raising their numbers and institutions keep buying, the underlying business is usually exceeding expectations. Nvidia has beaten earnings estimates for 8 consecutive quarters, but momentum is a lagging indicator. It tells you what happened. It doesn't guarantee what comes next. The risk is that when sentiment shifts, momentum names fall faster than value names. 3 real risks, not catastrophic scenarios, just the ones the data actually supports. 1. Customer concentration. Microsoft, Google, Meta, and Amazon together represent a significant share of Nvidia's data center revenue. If any major cloud provider slows AI spending or builds their own chips, Nvidia feels it. 2. Competition. AMD is shipping the MI300X, Google has TPUs, Amazon has Trainium. Intel is rebuilding. None are at parity yet, but the gap is narrowing. Custom silicon is a real long-term threat. 3. Export restrictions. The US government has already restricted Nvidia's most advanced chips in China. China represented roughly 20% of data center revenue before restrictions. That market is now structurally impaired. Factor score. Evidence business quality. 9-10, dominant GPU market, 74% gross margins. Real pricing power. Minor deduction for customer concentration. Valuation. 5-10, 65-70x forward. PE. 100x plus PFCF priced for the bull case. Not extreme, but not cheap. Momentum 8-10-8. Consecutive earnings beats. 150% versus Nasdaq. Rising institutional ownership. Risk. 5-10. China export restrictions. Rising custom chip competition. Customer concentration. Sentiment. 7-10. Institutional interest elevated. Retail cooled from peak. Not at euphoria levels. Total 34. 50 verdict. Exceptional business. Premium price. The risk is what you pay, not what they build. Most investors treat valuation and quality as the same thing. They're not. A great business at the wrong price is still a risky investment. Cisco in 1999 was an exceptional business. It took 20 years to recover its peak price. Nvidia's quality score is real. But quality doesn't protect you from overpaying. The signal score separates those two things. A 9 in quality and a 5 in valuation is useful information. Don't collapse them into one number. The other mistake, anchoring to the story. AI is the future is probably true. But being right about a trend doesn't mean being right about a stock. The market may already know what you know. Nvidia is a high-quality business with exceptional fundamentals. But the stock is priced for a future that must arrive on schedule. At scale, without disruption. That's not a reason to avoid it. It's a reason to understand what you're actually buying. If you want to see the signal score on AMD, Nvidia's closest rival, that video goes up. Subscribe so you don't miss it.